for that nice introduction.
Yeah.
Yes, as you said, a lot of the folks in the quantitative finance came from, physics labs and physics background initially. So, it's the finance field is actually very, very scientific in its discipline because of that, thanks to the physicists from Bell Labs and lots of other places. Nice to meet everybody. Good morning to those in the West Coast. Good afternoon to those in East Coast or Europe or wherever else in the world you are. Um, I'm going to be speaking about future or forecasting the future in finance. And I work within the Chief Technology Office at Bloomberg as a team lead or head of the Quantitative Research Solutions team. And before we jump into the technical portion of my talk, let me just sort of give a background on our company. I guess most of you folks probably know Bloomberg as a news company or a media company, maybe a data company. But what I want to emphasize is that Bloomberg actually is sort of more of a technology company than anything else. Of course, we have a big news organization. We have our own journalists, and we have presence in almost every country. But about 30% of our staff are actually technology people, and a good fraction of that is PhD level scientists, so what we call quantitative scientists or AI and machine learning researchers. And we have basically been putting out our product much more in sort of a technology platform landscape, working with open source technology, contributing back to the community, leading the efforts in the technology space for the financial industry. Just to give you a bit more of what Bloomberg is really all about, is really taking in all this wealth of information which comes in through news or analyst reports from the sell side institutions, all kinds of filings data from hedge funds and the owners of assets, of course social media and the web data. And Bloomberg helps sort of process all the data in real time and extract the right information out of it. And then we present that in what's our flagship product called the Bloomberg Terminal, which you may have heard of. So that's our main product for portfolio managers and traders and analysts. But for data scientists and quants, we are actually offering a much more flexible open platform called the Bloomberg Quant platform, which allows users to take Bloomberg data via APIs and Bloomberg models also available via our cloud services, and really allow you to build your own models on our ecosystem. So essentially, not just taking Bloomberg's model as the default, but bring your own assumptions, bring your own data even, and then build a solution which is customized for your use case. And that's really the next generation of Bloomberg product is going to look like. Of course, so a lot of the things, my talk is going to be focused on forecasting. So that's the rest of the content here. But we want to emphasize that the investment into machine learning and AI at Bloomberg sort of started with our real-time news processing initiative. So how we tag every single news item that flows through our ecosystem with the sentiments that are expressed in that news item, also with entities like people, companies, locations, brands, as well as topic codes. So we try to tell you as much as we can about every single document, every single news story, and then you can consume that data and build trading strategies on top of it. Of course, we have taken AI and machine learning efforts beyond the news and the document analysis part of it to really sort of marry the field of quantitative finance with machine learning. So quantitative finance used to be sort of more prescriptive in its sort of most vanilla format earlier. So a lot of the folks were of the scientific bent. They will make assumptions about what kind of processes if financial instruments prices follow, and then we will try to calibrate a particular parametric process that can explain the data. But of course, as the amount of data and as the amount of coverage in terms of number of companies, number of asset classes, number of instruments have just gone up tremendously, we have sort of put that on his head and said that let us not make assumptions about how we think these prices are evolving or these processes are behaving. Let us learn that from the data directly, so without making any strong assumptions. So that's sort of bringing the best of data science and machine learning and marrying it with the quant finance discipline. So use the structure wherever you think is clearly present, but when it's not present, use the best of the learning models to try to uncover the truth via data-driven processes. And one of the areas we are applying that is in the forecasting, and that's where Bloomberg is obviously synthesizing a lot of information that comes in through our analysts. So we have economists on our platform. We have sell-side researchers who are giving us estimates for various kinds of metrics. So earnings per share or dividend or sales or revenue for every company. And Bloomberg is taking that vast amount of information and then combining it or aggregating it at a company level to see this is what we think is the best forecast for IBM sales going forward, knowing that all these forecasters are coming into the single process, and we have to provide the best aggregate consensus using machine learning methods. So as we know, forecasting obviously is very, very hard problem. And Paul Samuelson, the famous Nobel laureate, tongue-in-cheek, has said like stock market tends to predict 9 out of the last 5 recessions, which is essentially an statement about overfitting, how we sometimes build models which are overfitted to history, and how can we avoid that in a more robust framework that we need. There's been a lot that's been said about forecasting methods in general, and there was a book which was a bestseller, a New York Times bestseller, by this famous author Philip Tetlock, who's an economist and an academic at Ivy League institution in UPenn, and basically the theory is that all forecasters are bad, but there are some forecasters which are better than the others. So there's this notion of foxes versus hedgehogs. So foxes are the kind of forecasters which know many things about a certain topic. So they will know, they'll have a broad knowledge about a certain topic. And hedgehogs are the so-called experts, which have deep knowledge as opposed to broad knowledge about a very certain specific topics. So in Philip Tetlock, in his book that he authored with a journalist, Dan Gardner, says that combining many foxes is actually better than using a single hedgehog, which means that if you just take many people who know broadly about the subject and just average their answer or come up with a consensus, you will do better than a single expert. So there's experiments that have been done. So in particular, what's known as the wisdom of the crowds, where about 100 years ago there was this experiment which got the weight of a cow within 1 pound accuracy by just averaging common people guesses. So that's sort of like maybe a cherry picking example, but the idea really is to harness the wisdom of the crowd. At Bloomberg, we have this function called Whisper, where anybody with the access to Bloomberg systems can actually whisper a number, which basically means that submit a forecast for any target indicator, whether it's foreign exchange rates or economic indicators or commodity prices, and we will put all that information together and provide you with the wisdom of the crowd answer. And of course, this has been proven or shown in other areas where apparently regular people are better than CIA for predicting political events. So this is nothing really sort of a new idea of Bloomberg. It's known that wisdom of crowds is definitely a good way to do forecasting than relying on experts all the time. But of course, as data scientists and quants, we have to deal with the practical aspects of that problem. So when we dive into this forecasting use cases, we have to look at first and foremost what we call error checking. So we know that forecasters come with a lot of different types of errors in their raw data. So we have to first make sure we clean the data properly, again using data science and machine learning methods. And then the second phase is of scoring. So once you have clean data, then we can think about how can we go about scoring a particular analyst or particular economist. And once we have done the second stage of scoring methods, then we have a very good handle of ranked order or quality order of these different forecasters. And then we can combine their forecast into a sort of a smart consensus or a premium consensus that will presumably a better forecast than any single forecast itself. So talking about the error checking, so just sort of a tongue-in-cheek comment here again, forecasts are either lucky or wrong because we know forecasting is very hard. But to make it a more practical setting here to clearly distinguish different types of errors is very important. So errors are not of a single variety. We see, for example, errors which are simply like fat finger mistakes. So like sign errors, which if a number was supposed to be around 4 million or minus 4 million in this case, some sort of a debt of a company, but some analyst entered 4 million, assuming it was capturing the right sign. But of course, when the numbers flow into our systems, they sometimes come with the wrong sign. In other cases, we have scaling errors, which are, usually numbers which are mentioned in thousands or millions, and maybe gets rescaled in billions, and will be off by a factor of 1,000 or a factor of million. So we sometimes the forecasts don't come in the same units, and we have to correct for the scaling errors automatically. And then there are the hardest beast of general outliers, because that's a very subjective class of errors. Outliers are not as precisely identifiable as sign or scaling errors, because it sometimes needs a little bit of subjective input as to something, whether it's really an outlier, an error, or is it just a bold forecast which is away from the other forecasters. And then finally, we need to also kind of take a step back and say that some of the errors that we may have identified may actually have been incorrectly classified. So sometimes we see there's a genuine shift in the market. So we have, this chart here at the bottom right shows you a genuine shift in the market due to COVID, which we are all experiencing right now. So every as early this year, starting in March, April, we started to see analysts suddenly starting to downgrade companies and shift their forecast for their sales and revenues. And we should not be taking those shifts as an indication of errors, but they should be correctly classified as a regime shift. So we have to put a layer of regime detection on top of this error checking methodology or technology to uncorrect or sort of actually unflag, I should say, some of the errors we have incorrectly flagged. So a basic data science algorithm for error checking starts off very simple. You essentially have to start with a basic building block, which is some sort of central value, which we can use the median value of the forecast, and a deviation metric to define an acceptable range. So you take a median value and you take plus and minus 5 deviations around that median value that is shown in the green bar, green vertical line, and the shaded region is the acceptable range region to define a valid range. And so any data that is outside of this valid range, for example, what you see around -4, will be classified as an error because it's outside that band. But if you flip that value, if you flip the -4 value, and if it then lies within the range, then it's a sign error, because clearly if it came with the right sign, it would have been exactly in the acceptance region. And then we can check, if it's not a sign error, then we can check for a scaling error. If it's more than 5 times the median or less than 1/5 of the median, then clearly it's basically 10x or 100x or 1000x or something like that, which is a scaling error, and everything else is potentially an outlier. So this is sort of our basic waterfall of error detection. But then there's a lot of bells and whistles that we need to worry about. So the deviation metric that I mentioned earlier, we do have a couple of choices. What we can use is either a median absolute deviation or a mean absolute deviation. The mean absolute deviation is very similar to the popular standard deviation concept. It's actually not very robust because it is sensitive to outliers themselves. So if there are outliers in the data, the mean absolute deviation will be higher. So it will be actually difficult for you to find the outliers because the deviation itself is too large. So the acceptance range becomes too big. On the other hand, the median absolute deviation is always less than the mean absolute deviation. So the band is much narrower. So that we have other kinds of problems with that, which means that we may end up flagging too many errors with the median because the band is too narrow. So almost everything may fall outside of the band. So there are these basically these trade-offs between these two different metrics, and we find a way to actually intelligently combine both in a very sort of a handcrafted algorithm that I'll show you. We find that mean, because is very large, mean deviation can be very large. It's a very conservative starting point for us. So first we find out the really true egregious errors by using mean, and then we can switch to median, because median is giving us a very narrow acceptance range, which is perfect for a sign error, to identify a sign error. So here we go. So what we do is we actually build in an ensemble of these different choices. So first we build, in the first pass, I should say, we use the median and the mean deviation, which could be large, but is sufficient for us to find really big scaling errors or really egregious outliers. And once we have taken care of those outliers and thrown them out of the data, we have purged them out of the data, then we can follow that up with a median deviation pass, which is really precisely instrumented to identify the sign errors. And then we do a cleanup third pass, which is again using a mean deviation to find out sort of the regular outliers, which is only made possible because of the first two steps. If we didn't do the first two steps, then we will have a very poor outcome in the third step, because it will not be able to identify the regular outliers, because irregular outliers will look actually good data in presence of egregious outliers or scaling errors or sign errors. So we have to first clean up those varieties or those types of errors to be able to do a good job of regular outliers. So this hopefully gives you a taste of how we need to sort of handcraft this algorithm to make sure it's doing the right things. Of course, a challenge in this problem, as in any data science or machine learning problem, is of sourcing the truth, because at the end of the day, all these algorithms and models, they need to be calibrated to the ground truth, right? And of course, we would like to have the truth, the whole truth, and nothing but the truth, but turns out it's not always possible. In particular, for forecasting problems, we know that we have millions and millions of forecasts in our data system, and we possibly can't ask our annotators to tag all of those data points as with ground truth for us to build a training sample. So the training sample itself will have to be curated as a very small sample. So we can only afford a small amount of truth. We can't afford the whole truth because that was just too time consuming, given the nature of the data, and also the class imbalance really is very important play here, because 99.9% of your data will be good. Only 0.1% of the data is actually likely to be errors. So you can't ask annotators to spend their valuable time just tagging data which is clearly not an error. So you have to make sure that you give them data points which are either likely to be errors or are on the boundary or the edge cases, for us to really learn better from that truth. So the truth itself has to be carefully sourced. And the second challenge, and at this point often does not get appreciated very well, is that truth itself can be multifaceted. Um, so there's no commonly understood definition of truth sometimes. So as you can see in that picture, that object looks like a square in one projection and a circle in a different projection, and that's true because we find that for forecasts as well, sometimes it's very difficult to tell whether an error is a sign error or an outlier error, because if a metric takes both positive and negative values, um, a negative, if it's majority positive values and you see some negative values, they could be outliers or they could be sign errors. And only a data expert or domain expert can tell you that, and sometimes even domain experts may not agree on that. So you can imagine how complex this can be when truth itself has an inherent error in it. So there's an inherent error in the truth, and then there is an error in the annotator's version of the truth. So we are sort of like doubling up these kind of, or magnify, or adding up these kind of different errors in the data. And you can only imagine that machine learning models, which are only as good as the data that they're given, will will be very sensitive to these kind of issues with the truth data. So the challenge that they throw at us is when the annotators come back to us, and they want us to give us for our models to be calibrated on their truth data. They say, can you handle my truth? And luckily, I think based on the based on the on the type of algorithm that we have crafted, we were able to do a very good job. So this is sort of just a summary of what I was talking about in the previous slide. How we have to source the truth very carefully, how we have to deal with inconsistency in the truth, and how we can bring more scientific rigor in this process of sourcing truth and the fine tuning of the models as directly. But here is our answer to this challenge: can we handle the truth? And the answer was that yes, we are able to handle the truth, well, at least to some degree of satisfaction here. We have three different kinds of flags here, or data points. So the greens are the sign errors, the reds are the outliers, and the blues are the no errors. So you see this sort of black lines, which are our decision boundaries in our algorithm. So black lines are determined using our algorithm, and you can see the black lines divide the region of this two-dimensional region into three subregions, and those three subregions are doing a reasonable job of classifying those kinds of errors. So each region gets each type of error in a majority. So if we follow those lines, those decision boundaries, we will do a very good job of flagging the errors correctly. Of course, this is a narrower version. It's a 2D view of a full 8-dimensional feature space. So you can imagine how complex this might be if you were to if I were to show you this in full glory. But hopefully this gives you a taste of how the challenges of sourcing and fine tuning, and then finally coming up with a model that does a good job on that. And of course, at the end of this, again, we have to add that regime detection flag. So we look at trend of the data. So if you suddenly see a lot of errors being marked or flagged, which all are clustered in time. So let's say over the last month or 2 months, suddenly we have 50% or more of the data points as erroneous. That will signal to us that something is going on with the shift in the data. So there's a market shift or data shift, and we basically take those clustered set of flags and we call them a regime detected scenario. So giving a signal to our data annotators that these flags are possibly not errors because these are valid data shifts. And of course, we try to use full transparency in providing that, so that our data annotators can do a very good job of remediating the data, because they have to go and correct for mistakes. So we don't want them to waste their time looking at regime flags, because most of the regime flags will be non-errors. We really want to them to focus on the big scaling errors and the sign errors and correct them in the system. So all of this helps in their workflow. And this is sort of a final view of the confusion matrix that we get. Again, you don't have to look into each and every number there, but basically highlighting the fact that most of the numbers are along the diagonal, which is good for a confusion matrix. So we see that we are able to identify errors properly. And what's very interesting is the objective function that we have to follow. For certain types of errors, we care about recall, and for other kinds of error, we care about precision. So for example, for outliers, we care more about precision, because there's more number of outliers, general outliers in the system, so they cannot be manually remediated because that's just too expensive. So we want them to be super precise, so that we can just automate that process. So no manual intervention is necessary. For scale and sign, since these are bigger errors, we want them to be manually confirmed. And for that, we care more about recall, because even if you have 60% precision, we don't care, but we want to make sure every scale and every sign error is captured. So here we see we actually get 100% of the scaling and 95% of the sign. And for outlier, we get 97% precision. So we are in high 90s for the metrics we really care about. For sign precision, as I said, like we get about 70% precision in sign class, but that's less important, because signs is the objective, which is more important, is a recall. We want to make sure we have captured every kind of sign error in our model. Anyhow, so the next step in this process is about, once we have cleaned up the data, how do we rank the analysts and how do we build a consensus going forward? Bloomberg, at Bloomberg we capture data for FX forecasts. So this is a screen, FXFC on Bloomberg, and you can see we have ranked orders, different forecasters. And also this is a different screen for economic forecasts, and we have again ranks here that we have put out using our models. Of course, we only give out the top ranks and not all the ranks, because we don't want to tell economists they're doing so poorly, just to sort of highlight the best ones and like the top 20% basically, and leave the rest of the rankings as not available, so that we can really take advantage of the best in class without beating up the rest of the analysts. So in order to rank and score these analysts, there's a lot of factors that we use in our models. As you can imagine, accuracy, of course, is the topmost one, but we should not just stop there. Accuracy is important, of course, in judging the quality of a forecaster, but there's a lot of other factors which are important. For example, timing. So a forecaster which gives a forecast early on should get some credit compared to a forecaster which gives you the same forecast or same accuracy later on. So the person who actually had the similar accuracy earlier should be favored. Direction is very important. So sometimes, forecasters may not get the forecast spot on, but they said something will go up, and the actual quantity or the metric actually went up. So that it's impactful because these forecasters are basically being used by buy side for building trading strategies. So as long as they pointed their finger in the right direction, they kind of did their job, even if they did not get the exact number right. And direction itself is very informative to their clients. Boldness itself is another metric where we want to call out the most courageous or the forecasters which go out on a limb and say that I want to be different. I want to be bullish on this metric for this company. And if they end up being right, then they get credit for that because they were brave enough to stand away from the crowd and give a forecast. And in terms of aggregation or building a consensus, we care about these principles of uniformity and transparency. We want to be able to come up with a uniform scoring method so that we can aggregate the scores across different periods. So across non-volatile or volatile periods, across different measures. So not just sales, but how about we come up with a ranking for analysts across sales and dividends and revenue, and all those scorings should be apples to apples and should be able to aggregate, as well as countries and sectors and things like that. So we should be able to aggregate any sliced and diced view of these analyst space and have comparable scoring methods. So scoring methods should not have any bias or customization for specific type of indicators. And finally, transparency is important. So our method should be, hopefully explainable, simple, and transparent enough that we can educate our clients so they can understand exactly what's going on behind the scenes. And also we can use this transparent scores to build this Bloomberg premium consensus or a smart consensus number as well. I will not bore you with this slide because it's really just emphasizing about the benefits of scoring using normalization and aggregation. I think we have learned that already. Direction is also, as I said, was an important factor. So, for example, we want to make sure, there is for FX spot rates, we have essentially this matrix of outcomes that are possible, where forecast direction could be up, down, or flat, and the actual could be up, down, or flat, and based on exactly where you lie in that matrix, you could get one of the three direction scores. So 0, 0.5, or 1. So 1 is exactly, you got it exactly right. 0.5 is that, either you set flat or the market was flat, then you get a partial score. And if you got to get it completely wrong, then you get a 0 score. Finally, timing. So timing is very important. So,
Dr. Verma, try to wrap up.
Okay, sure. So, so for timing, we basically use this square root law of volatility scaling to say that any errors in the forecast should be scaled by the square root of time remaining to the forecast. So this is really a way to normalize the errors that you see earlier on in the prediction process versus the forecasts that come in very close to the declaration time or the actual release time. For some indicators which are non-tradable, we need to use a slight variation on the square root scaling because there's a certain amount of uncertainty that is not resolved for non-tradable indicators. For tradable indicators, we know that the actual value will be equal to the spot rate, because the FX rates are observed in the market. For economic indicators, we don't know the actual values. They are not observed in the market until they are released in a economic release. So we use a different method there. It's really you know, talking about the known unknowns and the unknown unknowns, because volatility is usually a known unknown, because we know how much volatility there is for the tradable indicators. But for non-tradable indicators, we have an unknown component which has to be handled using the right statistical methods, which I describe here. I won't go into detail for the interest of time. And finally, when we have cleaned up our forecasts of their time decay, timing, as well as direction, we essentially go back to doing what we call high school math, which is like essentially grading on a curve. We basically put all the analysts and their forecast, their normalized forecast after all the corrections, on a curve, as you will, as a high school teacher will grade their students. And for a forecast which is exactly at the red line, all the green points in that under the curve are actually worse than the red, because they are further away from the black value, which is the actual value. So anybody who is in the white region between the two red bands is better than this target analyst, and anybody who's in the green region is worse than the target analyst. So essentially, we just calculate the area under the curve, which is green, and we call that the score for that analyst. And then once we have the score for every analyst, we can then do a weighted sum of these score weighted average to build a premium consensus. And we have shown in our analysis that this premium consensus beats the other two benchmark or baseline methods. So what we call Mr. Forward and Mr. Consensus. Mr. Consensus is just if a virtual forecaster, which is just doing a median of all the forecasts. Mr. Forward is looking at the markets data of the actual spot rate, which are currently being traded as a way to flat forecast. And we can see that forecasts are valuable, but they're especially more valuable when they're combined in more intelligent ways, like we do for Mr. Premium here. Okay, with that, I'll end here. So any guesses on what is really the future of forecasting? So I guess the answer is we should go with the consensus. So I hope that's one takeaway here, that we have said that we should really go with the wisdom of the crowd. We should really harness all the data and the value in the data, rather than going with a single expert or a single forecaster. But of course, we know that Niels Bohr put it out very succinctly earlier. Prediction remains a very difficult task, especially if it's about the future, just tongue in cheek. But we have to still be very robust in our methods and in our scientific rigor that we use to build these methods. This is still a I wouldn't say unsolved problem, but a very tough problem to really show that the forecasting has some predictive power, and it's not just a combination of what forecasters already know. So we've been able to do some back testing and predictive modeling to show that the forecasts were really a causal driver of something that we observe in the markets as the future values of those companies' metrics. With that, I'll end my talk.